good morning, good evening, from wherever you're watching us from. My name is Ronald Kazadi. Welcome back to my channel. So today we're going to touch on a very interesting topic, a topic that you've been hearing probably in the news these days, and that is how do we beat inflation? So the topic mostly is what is inflation? Now, everywhere everyone's talking about it, inflation, prices are going up, so we're going to deep dive into what it is, how we can defeat it. So what will we learn in this video? Well, you first need to know what inflation is. I know most of you have an idea, but then we will dive deeper into what it actually is. Factors that cause inflation. How do we measure inflation? Why should you care about inflation? And how to beat inflation. So, without further ado, what is inflation? In economics, inflation refers to the general and gradual rise in the prices of goods and services in the economy. As general price levels rise, less goods and services are purchased by each current currency unit. So what that technically means is that the reason why prices are going up, it's because there is less supply. Therefore, inflation responds to a decline in purchasing power of the money. The opposite of inflation is deflation, a persistent decline in general price levels of goods and services. So in a nutshell, inflation is the rise in prices. So if you used to buy an item for $2 in the last 10 years, and now that same item that is worth $2 is now $10, that is as a result of inflation. Now remember, it's gradual. That means it's not steep, unlike a hyperinflation where it happens overnight. Inflation happens gradually. So gradually over time, you realize there was a general rise of prices, and simply because the demand for it cannot meet up with the supply. And this is what's happening in the world today, whereby you have so much demand, because the supply chains were affected by the lockdowns. There is less supply to meet the demand, so therefore that's why our prices are going up. So factors that cause inflation: demands for goods and services. I think this is obvious for those who've studied economics. For you who don't, when there's more demand and less supply, prices tend to go up. When there's less demand but more supply, prices tend to go down. Supply for goods and services fall. This mostly happens during a recession. Now, almost all the developed economies experienced some level of recession last year, but that has really caused the supply for goods and services to fall, and therefore that has caused, the current inflation, because as this supply fell, demand for it has been going up since economies have been recovering. But the supply of the recovery is just not meeting up with the demand. Increased money supply. So what happens is that central banks, trying to revive a stagnant economy, prints out money as part of their ways to get people to spend or businesses to borrow money. So that in itself, when there's too much money into circulation, that causes prices to rise, as everything behaves more like a sponge. You see, when there's more water in a sponge, what causes the thing? It begins to contract and um, sort of bring more water into it, so it absorbs more water. So that's the same thing what happens in an economy which has been flooded with money, is that it just brings in more demand than the actual goods in circulation. So the more the money goes into a particular economy, the more there's demand for certain goods and yet the supply for it is non-existent, or the value of the goods that exist in the economy is non-existent, so therefore prices tend to rise and demand for it tend to rise, that just can't meet up with that supply. So demand for money falls. So if now more and more people now in an economy where it's flooded with money, if more and more people now do the opposite, instead of spending they save, that still causes prices to rise up, because now we've got a stagnant economy, but yet these goods need to go somewhere, so prices will go up as the velocity of currency is either being tampered with. So the scarcity of that currency tends to just drive everything to oblivion. So these are the factors that cause inflation. How do we measure it? Well, there are two things. There's PPI, which is producer price. This is producers prices including tax. So what happens is this measures how, just keeps tracks on how producers are doing in terms of their purchasing power. So this actually is a leading indicator of what's happening in the economy, because usually when commodity prices go high, producers tend to have more burden as their costs go up. So one way or another, this will affect their pricing. So this will affect their markup. So when they start charging you, they will charge cost plus markup, which if you've done accounting, it's generally how prices are calculated. So your producer must know how much it cost him and how much he can charge you extra to make profit. So the more his costs go up, the more likely it is that the charges will go up. So therefore there's not a level playing field in it. So it includes everything, even taxes and VAT. So there's a general formula of what producer prices are, and then CPI is what most traders look at. But again, a model like CPI is a lagging indicator, because this is just generally tracking at consumer prices over time, which generally might not give a great picture of what's to come or what's coming. That's why I prefer the PPI mostly, because there you're actually looking at the inflation that ought to come. So if generally producers' prices are steepening up, it simply is an indicator that something is happening in the economy. And usually the industry that is mostly affected by inflation is usually the commodity market, because as tons of money is flown into the economy, demands for all these goods are just pushed, and therefore their prices go up, like lumber, copper, which are your industrial commodities, like energy, which is oil. They all go up. Even your precious metals also go up. So most of the more affected market is the commodities market. That's mostly affected by the inflation. So once this prices go up, you can tell that in the next 3 to 4 months we could expect a general rise in prices, as purchasing power of the producers of the producers are going down. So therefore they might raise their prices to meet up with the extra costs. So yes, so CPI is a statistic estimate made from prices of samples of representative items that are priced in on a regular basis. So simply this is an index. So they take a basket of prices, maybe for bread, milk and whatever. So they put it up together and they weigh it in an index. So if that index keeps rising, it simply means the prices for all these basket of items are rising. So therefore consumers are experiencing a steep rise in their prices. But as I said, it is a lagging indicator because it is simply telling you what consumers have been experiencing for some time now. While PPI tells you what producers are experiencing at a time, but this gives us a general idea of how the consumer's pocket will be affected. So that can give us a general idea of inflation. But another inflation measure that I forgot to add here is the inflation deflator, or the GDP inflator, which is also a very good track of inflation. And another one is the PCE, which also tracks inflation, personal consumer expenditure. So why should you care about inflation? Simple. You see, if you've got, let's say, $1,000 and inflation rate per 10 years is at 5%, an example. So that $5 in 10 years will equal to $600 today. That means your purchasing power has been reduced to $600. For you to meet up with that, so let's just say if you try to get an investment that yields you 5%, and if we take that 5% and we divide it including tax, so let's just say you pay 6% of tax. We say 5 divided by 0.6, that's 8.3% that you need to fight both inflation and your taxes. But that's the thing, which investment will give you 8.3%. So that is why you need to know what would work for you in such an economy. So how do you beat inflation? So if you are a borrower, this is a very good time to pay off your debts. Why? Because interest rates are still low, and so when inflation rises, interest rates tend to go up, and this will have an effect on your debt because your debt will become more expensive to pay back. So if I were you, this low interest environment, this is the best time to pay off all your debt, mortgages, car loans, everything. Pay back all of it, credit cards. This is a very good time to pay off all your debts. But as an investor, what should you do? You should do the following. Buy inflation-linked bonds. So these bonds are linked to inflation. Remember what we said? We need that 5%. So if you can get an investment which is 5%, you would have combated the inflation rate every single time. So these are linked to inflation. So the more your inflation rises, the more returns you will get from these bond yields, because unlike normal yields, these yield according to the current inflation rate. You should also buy blue chip stocks because they pay higher dividends. Remember that 8.3% that we need to help us to pay back, to help us to combat inflation as well as pay tax. So that 8.3% or more is what we need from the blue chip stocks. They pay higher dividends. They are able to help you to earn an income every single month. So in that way, you are safe from any inflation economy that is struck by inflation. Retail bonds, these are bonds, unlike government bonds, these are bonds of businesses, corporates. So they are the ones which you buy from corporations. And if you want me to talk about bonds, please comment on the comment section, and I will do a video about explaining what bonds are. But in a nutshell, bonds are a form of IOU. So you buy this, you're currently lending to an institution money, and they promise to pay you back. So retail bonds are bonds of corporations, and the good thing about them is that unlike government bonds, they tend to pay a higher yield. So that also is what we need for that 8.3%. But the bad thing about it is more risky than government bonds. You're short with government bonds to get back your money, but with corporations, not so much. But they are also a very good investment to combat inflation. Gold, the hedge against inflation. It has a track record of 5,000 years of beating inflation and government debasement of their currency. So when governments print more money, and as we see, printing more money is the cause of inflation, gold has a track record of beating inflation and also government debasement of currency. So that is a very good and stable investment for those of you who feel that the others that I've mentioned are riskier. And then cryptocurrencies. Well, as you've seen, Bitcoin is $70,000 earlier this year, so that would also be a very good suggestion if you're into cryptocurrencies, to look into that and hedge against inflation. But overall, inflation is here and it's here to stay. And the Fed had continued with the narrative that it was transitory, the Fed. But we have seen that it's not transitory. That's why they are making new attempts to hike interest rates as soon as possible. And it's not only the Fed, even the Bank of England, everywhere in the world, central banks are panicking because inflation is on their radar. So us as investors, we should be armed. So if you want to learn more about these things that I've mentioned, I've listed some good books for you to read from in this festive season, so that you can be armed next year to beat inflation at whatever rate it comes. Thank you very much. I hope you enjoyed this video, and I have also taken liberty to select certain videos that you might be interested in. Thank you very much, and enjoy the rest of your day, evening, or morning.